Silver didn't just bounce this week, it reacted under pressure. What you're seeing, that sharp move from roughly $61 back above $70, isn't stability. It's a response, a reflex. The kind of move markets make when something breaks too fast and needs to correct before deciding the next direction. Because just days ago, silver wasn't recovering, it was collapsing. Sliding from the mid-70s down into the low 60s, the kind of drop that doesn't come from calm repositioning, but from forced unwinds and emotional selling. And now, suddenly, we get a reversal. Headlines shift, talk of a temporary pause in attacks on Iranian energy infrastructure, hints of negotiation between the US and Iran, even as both sides contradict each other. And price responds immediately. That tells you something important. This market right now is not trading on fundamentals. It's trading on interpretation, on perception, on the next headline. So, when you see silver reclaiming $70, the question isn't, is it strong again? The real question is, what exactly caused the bounce? And is it durable, or just a pause in a much larger move still unfolding? Now step back. Because what's driving this move isn't supply, demand, or even valuation. It's the narrative layer shifting in real time. Over the weekend, you had Donald Trump signaling productive talks between the US and Iran, suggesting a potential de-escalation. Markets reacted instantly. Silver bounced, risk stabilized, but then Iran pushed back, rejecting parts of that narrative, reframing the situation as pressure, not progress. And just like that, certainty disappears again. This is the environment we're in, not one of clarity, but one of competing realities. And markets are being forced to price both at the same time. That's why you're seeing these sharp reversals, because price is no longer anchored to fundamentals. It's anchored to which version of the story traders believe in at that moment. One headline points to diplomacy, the next to escalation. And every shift forces capital to reposition instantly. So when silver moves back above $70, it's not because the system has stabilized, it's because for a moment the market believes in a less severe outcome. But belief is fragile, and in a market driven by headlines, not certainty. The next move isn't about what is true, it's about what is believed next, and beneath those headlines there's a deeper force building. The one that doesn't move in spikes, but in pressure that accumulates quietly over time, the energy shock. Because when tensions rise in the Middle East and infrastructure becomes a target, oil doesn't just move higher. It feeds directly into inflation expectations across the global system. You saw it already. Energy prices surged, and almost immediately the conversation shifted, not from growth, but from control. Central banks, from the Federal Reserve to the ECB and Bank of England, aren't reacting to silver or gold or even equities. They're reacting to the risk that inflation becomes embedded again, and that changes the entire equation. Because once inflation expectations rise, policy can't loosen. It tightens, or at the very least it stays restrictive. That's why rate cuts are being pushed further out, and why yields like the US 10-year hovering around 4.43% continue to anchor capital elsewhere. So when you look at silver bouncing back, understand this. The surface move may look like recovery, but underneath, the inflation energy policy loop is still tightening. And if that loop hasn't broken yet, then neither has the pressure driving this market. And this is where the real anchor of the market comes into focus: policy, not price. Because while headlines shift and silver reacts, the Federal Reserve, ECB, Bank of England, and Bank of Japan are all sending a consistent signal beneath the noise. We are not easing anytime soon. Inflation risks, tied to energy, supply disruptions, and geopolitical instability, are keeping them locked into a restrictive stance. Even as markets hope for relief, Jerome Powell hasn't promised cuts. Europe is still discussing potential hikes. And that alone reshapes the entire playing field. Because when policy stays tight, capital doesn't flow freely, it chooses carefully. Assets that don't yield, like silver, don't just compete on value anymore. They compete against certainty of return, against instruments like the US 10-year yield sitting near 4.43%. So the bounce you're seeing isn't happening in a vacuum, it's happening under a ceiling. One defined by central banks that are still holding the line, and until that line breaks, every move higher faces resistance. Not from sellers, but from the structure of the system itself. which means the question isn't whether silver can bounce, it's whether policy will allow that bounce to become something more. And then you reach the layer most people overlook. The silent competition happening beneath price. Because silver isn't just trading against itself, it's trading against yield. Right now, the US 10-year Treasury is hovering around 4.43%, which means for the first time in a long time, investors are being paid to hold certainty, and that changes behavior. Because when capital has a choice between holding a non-yielding asset like silver, with storage costs, volatility, and uncertainty, or locking into a fixed return backed by government bonds, the decision becomes less emotional and more structural. That's why you're seeing capital rotate, not because silver suddenly lost its long-term thesis, but because in the short term, money is choosing efficiency over protection. This is the shift. Markets aren't just asking what has value. They're asking what pays me while I wait. And in an environment where central banks from the Fed to the ECB are holding rates high, that question becomes dominant. So when silver struggles to break higher, even after bouncing above $70, understand this. It's not fighting sellers, it's competing with a system that now rewards patience in cash and bonds, and until that changes, every rally carries weight behind it. And this is where the structure of the market starts to reveal itself. Because what you're watching now is not accumulation, it's position clearing in real time. Look at the data beneath the move. Open interest dropping by 1.45% to around 6,222. Prices falling while positions are being unwound. That combination matters. It tells you this isn't new money stepping in. It's old positions being forced out. You see it across the board. Mining equities, tech resources, First Majestic, core mining, down close to 8 to 10%. European resource indices sliding. ETFs under pressure. This isn't isolated, it's systemic positioning being reduced. And when that happens, markets don't move on logic. They move on pressure release. Because in an environment shaped by tight central bank policy, rising yields, and geopolitical uncertainty, leverage becomes unstable. And unstable leverage doesn't negotiate. It exits, so that bounce back above $70, it may feel like support, but in a structure where positions are still being cleared, it can just as easily be a pause between waves of liquidation. And until the selling is no longer forced, but replaced by willing buyers, the market isn't rebuilding yet. It's still unwinding what came before. And this is where the contradiction becomes impossible to ignore. Because while price is struggling, the physical side of the market is quietly tightening. London silver inventories just dropped another 2.4% to around 27,065 tons, a signal that supply isn't expanding. It's being drawn down, and that matters. Because in normal conditions, falling prices should bring supply back into the market. But that's not what we're seeing. Instead, we're watching two realities unfold at the same time. On one side, the paper market, futures, ETFs, leveraged positions, still under pressure, still unwinding. On the other, the physical market showing signs of constraint, where availability tightens even as price declines. That divergence doesn't resolve immediately. It builds tension. Because when price says one thing, but supply says another, it forces a question the market can't avoid forever. Which signal is real? So when silver hovers around $70 after that sharp drop, understand this. It's not equilibrium. It's dislocation. And dislocations don't last. They either compress or they break. Which means the move you're watching now isn't just about direction. It's about which side of the market eventually forces the other to adjust. And this is where everything converges. Because the move you're watching right now is not the answer. It's the setup. Silver stabilizing just above $70 after collapsing toward the low 60 CES. Yields still anchored near 4.43% on the US 10-year. Central banks from the Federal Reserve to the ECB and BOE holding firm. And inflation risks still elevated as the Middle East tension continues to influence energy flows. None of these forces are isolated. They are interacting, reinforcing, and building pressure beneath the surface. So the real question isn't whether this bounce holds. The real question is, what happens when one of these forces shifts? Because if diplomacy between the US and Iran stabilizes energy markets, inflation pressure may ease, giving central banks room to pivot. But if tensions escalate, or if liquidity tightens further as debt refinancing accelerates, the system doesn't absorb that quietly. It reprices. And when that repricing comes, the levels you're watching now may not reflect value. They may reflect temporary balance under stress. That's the difference most people miss. They see price as direction, but in moments like this, price is just pressure being expressed. And when that pressure finally resolves, the next move won't wait for confirmation.